I look at what the swaps are pricing, and it's a 70% chance of a June 2022 rate hike. Agree or disagree?
Yeah, we agree. We think that Powell is definitely going to taper come November, and that's going to take us to about the middle of 2022. And so not only do we think that there's going to be a rate increase mid next year, there's also a possibility that we'll see two increases next year, depending upon how the economic trajectory develops.
So how does the curve evolve? Because key portions of it, it moved dramatically. You have the 5 and 30-year spread. I mean, that collapsed to about 85 basis points. 5-year break-evens hit the highest level since 2005. How does that evolve from this point onwards? What does the trajectory look like?
Well, a lot of it's going to be dependent on how the economy holds up in here, because the early indication would be you'd see a bit of a flattening, right? Because you'd see short rates go up and then commensurate inflation expectations coming down on the long end. But we are still in this position where we believe 2022 growth is going to be quite strong. In some ways, the pause that we've seen here in the fall just pushes out that demand into 2022. So we actually don't think that the curve is going to flatten quite so much as markets might expect, in part because of that robust growth. Having said that, we don't see rates backing up on the long end above 2%. So some flattening, but probably not as acute as one might have expected.
Is the Fed at risk of clearly being behind the curve given the events of the last 72 hours?
The Fed is watching a lot of indicators very, very carefully, as are many market participants. Clearly, there are significant inflationary pressures that are on the horizon. We've got concerns about wages. We've got concerns about owners' equivalent rents flowing through from higher housing prices. But the other side of it is that some of the year-on-year comps will start to get better next year. So the headline numbers may not be quite as eye-popping as what they would otherwise be. So it's definitely a very precarious time to try to navigate as we see the economy globally recovering into 2022, consumer demand quite strong, supply bottlenecks. Many of those things may be transitory, but that's exactly the issue that Powell is trying to keep in play, is that he wants to retain that optionality.
I mean, you talk about the difficulty of navigating these tumultuous seas, and one thing that's quite difficult to get your head around is sort of big tech. It's come very far in a very short amount of time. We've been speaking to some key voices, and here's what they had to say.
We're doubling down on everything in technology right now. It's such an exciting time. What an exciting time to be in our business.
I would say that if you're thinking of buying tech, if you're thinking of buying some of these frothy growth names, first ask yourself, what's my exit strategy?
Growth stocks have had an incredible run. It's just they've been the winners. They've been the drivers of this bull market. I think we're starting to see some cracks emerge, that there's probably better places to put your money going forward.
Absolutely tech. I keep talking about the Silicon Valley tax that we all have to pay. You have to stay in tech.
You want to own quality growth. These are companies that can navigate this environment. They can grow earnings even as the economy starts to slow.
When you sit down with clients and talk about this issue, what are you telling them about investing more and allocating more capital into big tech?
One of the big issues right now is it's less about the directional trade and more about the relative value trade. And one of the concerns about tech is that some of the valuations have gotten so eye-popping that especially if we see any interest rate increases, you could have some pressure at those companies. Now, that doesn't mean avoid tech. I mean, clearly there are good reasons to be involved in that sector. It's one that's very vibrant. Innovation is strong. You're seeing very high demand as consumers have redeployed capital. So we're not exiting, but we're trying to be a lot more balanced. So we like financials. Certainly, interest rate increases will help the financial sector quite a lot. And we saw that, earnings have come in quite strong in that sector. We still like consumer staples. Again, people are going to want to eat. They're going to want to take care of their personal needs. So there are other places that we just think are more attractive on a relative value basis.
I was looking through some of the research notes over the weekend, and one that caught my eye is Bank of America. They're actually saying, you know what, there's a correction ahead for European stocks. This is directly from that note. Their base case macro projections are consistent with a 10% downside in the stock 600 to 420 by year end. They're saying that the macro risks out of China, the worsening supply chain disruptions, the energy crisis. All of that is going to imply a bigger downside than they had initially expected. But that is sort of a bit of a contrast to what you believe in at the moment around the European proposition.
Yeah, we've actually been deploying capital to Europe, and we might be a little early there, but we actually think that 2022 is going to set up for a pretty good year for Europe. Certainly, they've managed some of the COVID risks a little bit better than other parts of the world. Relative valuations look attractive. If you look at the sector makeup of European stocks versus other parts of the world, they're much more geared to the recovery trade. So if we start to see, increased global recovery, that will benefit Europe on a relative basis. Now, there certainly are vulnerabilities, and you cited China as one. They are much more geared to China, so slowdown in China is definitely of concern. But we also think that you've got much more accommodative monetary policy in the region. So on balance, we actually like Europe.